Alright, observe this chart example. We have identified a supply zone. This zone is marked by a strong, clean downward move, with large red candles moving away from it. Although there is a small opposing candle, it failed to change the direction, and the market continued downward strongly. This sharp drop suggests significant selling activity by institutions, creating an imbalance and establishing a reliable supply zone. Before taking a trade, let's go through the checklist to confirm this supply zone's potential. First, observe the candles that form the move down. They are large, showing strong bearish momentum, indicating institutional involvement, a positive sign that this zone could hold when the market revisits it. This supply zone is fresh. It has not been tested since it formed. A fresh zone often responds more strongly because it hasn't absorbed any orders yet, making it ideal for a potential trade. As the price moved down from the supply zone, it broke through a previous demand zone. This is a strong indication that smart money is in control, adding more significance to this zone. Additionally, this setup offers a favorable 3-to-1 risk-to-reward ratio. This aligns perfectly with our goal, providing a limited risk and high reward potential. As the price returns to the supply zone, we monitor closely for a liquidity sweep. Here's what occurs. Smart money briefly pushes the price above the supply zone, sweeping liquidity by triggering retail traders' stop losses. The price then closes back below the zone, forming a bearish pin bar. This pin bar acts as our confirmation signal, indicating that the supply zone is still valid, and a market reversal is likely. Here's how to execute the trade. Place the entry at the close of the bearish pin bar, once the liquidity sweep is confirmed. Position the stop loss just above the pin bar's wick to control risk. Set the take profit target at the next support level. With everything in place, apply the set and forget approach. Allow the trade to progress without constant monitoring. The trade will either reach the target or hit the stop loss, making this strategy straightforward and stress-free. As shown here, by applying these rules, the market reached the target directly. This strategy is easy, simple, and highly profitable. Let's move to another chart example. Here, we're looking at a supply zone. Before jumping into a trade, let's make sure this zone qualifies as a high probability setup. The candles dropping from the zone are large and bearish, showing strong selling momentum. This suggests smart money involvement. The zone is fresh and hasn't been retested since it formed. Fresh zones often lead to strong reactions. As the price moved down from this zone, it broke a previous support level. This confirms that institutions likely drove the market. We have a favorable 3-to-1 risk-to-reward ratio, which is ideal for this setup. Now that the zone is qualified, let's see what happens as the price revisits. The price briefly moves above the supply zone, sweeping liquidity and triggering retail stop losses. Right after, a doji-tailed bar forms, confirming the reversal. The doji's long upper tail shows that sellers stepped in, rejecting higher prices. This tells us smart money is absorbing buying pressure, preparing for a move down. Now, you can place your entry at the close of the doji-tailed bar. Set your stop loss just above the high of the tail. For your take profit, target the next support level. Use the set and forget approach and allow the trade to unfold without constant monitoring. After the doji-tailed bar confirmation, the market moved downward as expected, hitting our target. Alright, before we move on, let's talk about something just as important as learning the strategy itself. The mistakes to avoid when trading this powerful scalping strategy. Now, you've got one of the most effective strategies in your hands. But here's the reality. Without paying attention to certain mistakes, even the best strategy won't help you make consistent money. In this real chart example, we've identified a strong demand zone. The zone meets all the necessary criteria. Large candle size, it's fresh, there's a breakout of structure, and the risk-to-reward ratio is favorable. You place your buy trade with the stop loss set just below the demand zone. The market then moves lower, dipping below the demand zone and triggering your stop loss. At this point, it's easy to feel frustrated, but this could simply be a stop hunt by smart money to sweep liquidity. So instead of reacting emotionally, let's look at what happens next. After your stop loss is triggered, the market returns to the demand zone and closes above it. This is an important moment. It signals another opportunity for you to re-enter the market. The initial move down was likely just a liquidity grab to trigger retail traders' stops. Now here's what you do. Stay calm. Accept that first loss and re-enter the trade. This time you place your stop loss just below the low of the demand zone and target the next level. This time, the market moves in the targeted direction and hits your profit target. By understanding how the market tries to play on your nerves with these moves, you've turned a potential loss into a profitable trade. Alright, let me walk you through another common trading mistake that many traders make when using this strong scalping strategy. So you're watching the charts and you spot the perfect supply zone forming. It looks like the ideal setup. But then, life happens. Maybe your wife asks you to do something, or it's time to take your kid to school. Suddenly you feel that fear of missing out. You don't want to miss this opportunity, so you rush to place a limit order, thinking the market will definitely respect the supply zone. You step away, handle your tasks, and when you come back, you're frustrated. The trade didn't work out, your stop loss was hit, or the market didn't react the way you expected. This situation is more common than you might think, and it's a trap many traders fall into. Here's the truth. Entering that trade because you feared missing out was a mistake. The supply zone is only one part of the strategy. Who said the market would respect that zone? If you trade like this without waiting for all the conditions to be met, you're still trading like an amateur. And let's be honest, that's more like gambling. You might think you're following the strategy, but in reality, you're rushing the process. You're not respecting the market, and when you don't respect the market won't respect you. So how do you deal with this fear of missing out when using a powerful scalping strategy like this? First, you need to shift your mindset. The market is full of opportunities. If you miss this one, no worries. In the next 5 minutes, 10 minutes, or even an hour, there will be another, possibly even better opportunity. Remember, you're scalping on the 5-minute time frame, and you can apply this strategy across all financial markets. Finding opportunities is never a problem. Let me share a pro tip with you. The real reason for your struggles in trading, or in life, comes down to you. Many traders, especially beginners, tend to blame their broker, the market, or even circumstances for their trading losses. But here's the truth. The problem isn't external, it's within you. The real enemy you're dealing with is your ego.